Hi business people, it's Nia here, and I am very excited. So much so that I even moved my intro to the beginning of this video just to get it out of the way. In this video, I'll be talking about the home buying process. Not in 2 steps, not even in 4 steps, but the entire whole process, the timeline from start to finish, as well as what a lot of home buyers in the United States do not know about, like the no down payment mortgage programs, or what does an excellent mortgage package look like, the big no-nos and things you should not do while you're buying a property, and also how do you determine what you can really afford versus how much you qualify for. I even have my handy dandy PowerPoint slides here to make this somewhat long buying process feel like you are shopping at Target. The goal of this video is for my business people, yes y'all, will learn everything there is to know about buying a property. If I do a good job, please subscribe and give this video a thumbs up. Now sit back with your notebook and your pen and let's get started. Since this is a condensed course, I provided an outline of what you all will learn in this video. So our discussion will range from whether buying or renting is the best decision for you, to shopping for a lender, to really great cash offer resources that you probably would never know about, and the post-closing period. So I typically don't formally introduce myself in my previous videos, but I thought it would be best that I tell you all a little bit about my background and my experience. So after I graduated college, I became a wealth management analyst for one of the largest investment firms in the world. I had a deep love for finance, like really deep. I even went on to take my FINRA Series 7 and 66 and pass on my first try. Those who don't know what a FINRA exam are, they help you to become a professional financial advisor. But when I actually joined the firm and started doing the work, I grew upset. I was upset that I was helping clients make millions of dollars while I wasn't able to trade in my own personal account. So as a professional financial advisor, you are restricted under law to not trade in your account unless you're supervised, right? So I had to submit tickets to trade, and it was actually hard to get approved. So I quit that job after a year and became a financial management consultant instead. And currently I am a full-time MBA student along with my consulting job. And through my MBA program, I apply a wealth of information to my current business as well as my YouTube channel. So before even graduating college, I was trading in stocks and occasionally options, but real estate has become a new avenue of income and obsession for me. I purchased my first property in 2021 and started my LLC business in January of this year. So I remember reading an article that quoted Andrew Carnegie that said something along the lines that 90% of millionaires generate their wealth through real estate. So the reality is that landlords and property owners are making a lot of money in their sleep. But there is a process behind that. It's not as simple as opening a Robinhood account or a Webull account. So with that said, let's start the course. So renting allows you to actually boost your credit score, unlike in the past, because credit bureaus are now considering rent to payment history as a result of formulating our credit score. But you have to make sure that your rent is being reported to the credit bureaus. I think it costs about $4 a month, or it could be free depending on your leasing company, but you must make sure that your rent is being reported to the credit bureau. And you can do that by contacting your leasing office or the management team. So renting comes with instant gratification. For instance, if your refrigerator breaks or your toilet is clogged, all you need to do is call your landlord or the property owner and get it repaired very soon. Money doesn't even have to come out of your pocket. You don't pay for any repairs or maintenance. So there is some serious instant gratification, unlike with buying a home. You're also able to have a flexible lifestyle. You're able to move between neighborhoods or even careers because there is no long-term financial commitment. Renting can be rosy, but there are surely some thorns. So let's consider why you should buy. So buying a home is one of the biggest financial decisions you can make as an adult. But it's also a great way to elevate your financial portfolio. Buying is the potential to build wealth and equity while paying down your debt and mortgage. For instance, California home values increased about 21% over the year. The national appreciation value is about 3.8% annually over a 10-year long span. Just know this appreciation rate of 3.8% includes rural areas where they won't see a drastic increase, like areas like Charlotte, North Carolina. Charlotte witnessed an increase of 25% in 2021, but an 86% increase over 5 years. So your mortgage payments tend to be fixed while your rent tends to increase over time. Also, buying a home is a great way to hedge against inflation because you're passing those higher prices through into your rent. And also, steady monthly payments allow for equity to increase. So let's now address the pride of ownership. You're not only building stability in your income, but also in your community and your school system and for your family. After determining whether buying is the right decision for you, let's determine whether you have the financial conditions to go through with it. Your credit score is one of the most important factors in this process, right behind the debt to income ratio. A 740 or more credit score is the ideal credit score. But there are mortgage programs that allow you to have a credit score as low as 580, like the FHA loans. Just know if you go below that 580, you will be required to pay a 10% down payment, unlike the 3.5% down payment of an FHA loan. You can get a free credit report at ftc.gov. So, how much house you can afford is not the same as how much house you qualify for. To prevent from being house poor, you should aim to purchase a home below your qualified amount, especially if it's a starter home. There are some leniencies if you plan to Airbnb, a triplex or fourplex, but if you plan to have a long-term renter, it is best to be below or at the qualified amount. You want to be mindful and realistic with how much house you can truly afford. I listed some ways you can measure this, from least conservative to most conservative measure. Number 3 is the most conservative. So number 1 is basically napkin math, right? It's a rough estimate of how much house you can buy, but it doesn't account for your debt. So I provided number 2 and 3. Number 2 is just saying that your home expenses, which include your mortgage, interest, taxes, insurance, fees, all of it, right, should not be more than 30% of your monthly income. So number 3 is the most conservative measure. It is the 28-36 rule. That basically says your total debt payment should not be more than 36% of your monthly income. Your total debt payments includes your credit card payments, your student loans, your car notes, all of the debt in your life. Then your mortgage, your home expenses, like I mentioned, interest, taxes, mortgage payment, HOA fees, anything regarding the home should not be more than 28% of your gross monthly income. I provided an example of $5,000 monthly income. Multiply that by 36%. That gives me an $1,800 as my maximum total debt. Maximum home expenses are calculated by multiplying $5,000 by 28%. That gives us $1,400. So $1,400 is allowed to be your mortgage, insurance, tax, HOA fees, all of that for $1,400 a month. These are very conservative numbers, but it gives you a sense of responsibility and accountability. You do not want to be house poor. Now let's address saving for a down payment, which is the most critical step and probably the hardest step in this entire process. It can take from months to years to save to purchase a property. So I provided a list of loan programs that don't require much of a down payment or no down payment at all. But if you don't qualify for any of these down payment assistance programs, you will have to take creative measures to saving, such as setting monthly and yearly goals and putting it on a refrigerator as a reminder. You can set aside specific savings or brokerage accounts that receive recurring deposits after every paycheck. Also consider ways to avoid PMI. I actually have a video on how people can avoid PMI, and I will provide the link in the description below. Also, buying a property as an individual is more of a financial burden on you and require you to save more. But if you go through with a joint purchase, like buying it with your family member or significant other, that will be less of a need to save more and more. There are HOA fees when it comes to purchasing a condo or a townhome. So you gotta factor in whether you're able to afford that, or whether that's gonna be cutting into your budget. Now let's get down to the pre-purchase timeline, starting with selecting a realtor, getting pre-qualified, and then receiving a pre-approval letter. So in places like New York and Los Angeles, realtors can be quite competitive, even to the point of suing each other. So for instance, if you tour a property with Realtor A and then you decide Realtor A is not the great fit, right? He's not responsive, he doesn't pick up his phone, he doesn't text message you, he doesn't send emails, he doesn't even run his comps, right? Yeah, I get the point. So you go to Realtor B, he is more competent, he is kind, he is responsive, and you decide like, I want to buy this property with you, Realtor B. Realtor A can come back and sue Realtor B and claim that Realtor B basically stole his money, stole his client. So to get out of this type of situations, you want to make sure that you tour the property with Realtor B again, right? And you also sign the buyer's agreement. This is the way where you're saying this realtor is my realtor. What I had with Realtor A, that was just a fling. But you have the absolute right to switch realtors. You are entitled to having a better experience. You have the right to switch. So don't let someone make you or pressure you into staying with a realtor because of the competitive market that we're in. But there is a thin line between a quality realtor and a not so great one. A good realtor will shop around to find the best property that fits your values, your interests, what you desire. And also a good realtor understands the process from start to finish. He or she knows the market, understand what kind of market that we're in, whether we're in a seller or a buyer's market. A realtor also pulls comparables. So comps help you determine whether a home is over or undervalued. I wish I had a realtor my first time that knew how to negotiate. Yeah, I lost out on understanding like the importance of a good negotiator. But in a buyer's market and sometimes in a seller's market, negotiation skills are very key to not overpaying for a property. Pre-qualification is a unique time in the process. This is when you really set the tone for the rest of the process. You want to be confident in your lender and your potential mortgage payment. So for pre-qualification for a mortgage, a lender considers your credit score, your debt to income ratio, your household annual income, your employment history, and to prove and back this up, they require certain documents. So I honestly regret having my first lender pull my credit score. I should have provided my free credit report instead and just tell him that this is my number, because I would have more time to shop for lenders. Shopping window is 14 days. That means your credit score cannot be negatively affected for 14 days after the first pull. Meaning you can have 20 different lenders look at your credit score within that 14 days and it would not be affected. I advise people to stay away from commercial banks and some online mortgage lenders. Going with the local lenders saved me thousands of dollars, and I was able to avoid points on my mortgage package. I even received a check back from my lender. Overall, my focus was taking my pre-qualification letter from one lender to the next lender, getting a letter from him, and then taking it to another lender, getting a letter from her, and then taking it to another lender. You get the point. But I did it about 5 times to get the best rate I could get. I recommend taking a look at credit unions like Pentagon Federal Union or University Federal Credit Union, or just local lenders and intermediaries. I think bankrate.com is a great resource to seeing what rates are on the market. Bankrate is a great way to benchmark how high a rate is and possibly how low you can get. When you enter the pre-qualification point, this is where you don't want to make any major purchases like buying a car, opening a credit card, quitting your job, or moving to another state. Mortgage lenders have even advised future home buyers to do none of these things or affect their credit for at least 3 months before buying a home. You should wait until closing or even when you receive the keys before you make any of these type of decisions. Let's talk about what a great mortgage package looks like. The name of the game in real estate is profit. So we want to obtain the lowest possible mortgage package relative to the desired property. Like I mentioned before, you don't want to negatively affect your credit score or your income during this time. I say the lower your interest rate, the closer you are to principal. To get a low interest rate, you have to have a good credit score. Being closer to principal allows you to pay off your mortgage faster. That means more income, more profit. You want to have 0 points. Points are also known as discount points, which are just upfront fees to lowering your interest rate. A lot of new home buyers are easily persuaded to get points on their mortgage package. Both mortgage interest and points are tax deductible, but in today's low interest environment, paying for points to lower your rate doesn't really make sense. If we were in a high interest environment, paying points can save us hundreds of dollars with a lower interest rate. But as of now, I advise against that. There are 2 different interest rates. There are fixed and then there's adjustable. Fixed interest rates are ideal if you plan to own your property for 5 or more years and there is a low interest rate environment on the market. But if you plan to own your property for less than 5 years or just short-term ownership, adjustable rate mortgage ARM is ideal, especially in a high interest rate environment. For example, we have the 5-1 ARM, which is a type of adjustable rate mortgage loan that says there's a fixed interest rate for the first 5 years and then an adjustable interest rate for the remainder of the term for every 12 months, which is the 1 year. Let's say my fixed interest rate will be 6%. And then on the market, suddenly the interest rates fall to 3%. This is how the ARM can be profitable for you. Now let's discuss the different types of loans. Generally, there is government-backed mortgage loans versus conventional loans. Government-backed mortgage loans include VA, FHA, and USDA loans. They have less qualification requirements and less upfront costs, but they do have more fees over the life of the term via MIP, which is mortgage insurance premium. To get rid of MIP, you have to put down 10% down payment and wait for the 11th year for it to fall off. Conventional loans have more upfront costs, aka a higher down payment, but require less fees over the life of the loan. For instance, PMI, it's easier to remove. I actually have a video discussing the difference between PMI and MIP, and I linked that video in the description below. Now, let's discuss cash offer resources. This is something a lot of home buyers do not know about, but these are successful startup companies that will help individuals make cash offers on your behalf, so you can be competitive in buying your desired home. Many individuals have been hurt by multiple and cash offer markets as we are in today. So we have Homeward, Homelight, and Knock. I provided these 3 resources because some of them are not in certain areas while The other ones can be found in this area. So please do your due diligence and look more into these resources if you're interested in a cash offer. Now let's discuss searching for a home. This is one of the most exciting parts of the process, but this is also an important part for you to advocate for yourself. You got the realtor, but your realtor is not meant to be your advisor. It's up to you to consider the state, neighborhood, and street, even the distance from work and nearby stores, gyms, and other community amenities that can really affect your day-to-day life or the day-to-day life of your tenants. Also consider the type of property. Like a condo versus a single family property presents two different lifestyles and also two different business models. For a condo, they don't typically allow Airbnbs, right? So you're probably restricted to long-term renters. For a single family property, you can have Airbnb, you can have short-term, middle-term renters. You have control over it. But guess what? That also comes with more fees. With a condo, most of the repairs and maintenance are done by the HOA board. Consider the age of the home as well. Do you want a charming 1950s home or a brand new one with less maintenance problems? Also, I really do advise that you do a night or late afternoon drive-by in the neighborhood of the properties that you desire. So if you don't get a realtor and you just want to do some research, you can look in Redfin, Zillow, Trulia, Hotpad, and other online platforms. But just know they do have a 1 to 2 day lag compared to the MLS. MLS is a multiple listing service. Only realtors have access to the MLS basically. But if you want to do some more stalking on a property and get really all the details from the name of the current owner, liens on the property, the mortgage, the home value, all of that, go to propstream.com. This is a great resource for new home buyers, but especially rewarding to investors. Now that you have toured over 20 homes from condos to multifamilies, you are ready to be like these people, dancing in your new living room or moving in new furniture. Now let's discuss buying a home. Submitting an offer is just a small dip on this roller coaster. I provided a list of the forms that your realtor has to prepare to submit the offer. The seller is able to immediately accept or counter the offer, and as a result, you can either accept the seller's response or just leave the deal. And then we will discuss opening escrow. So submitting the offer. Never submit an offer without an inspection contingency. You don't want to find out your foundation is weak or your roof is leaking after buying $1 million property. In the seller market that we're experiencing right now, sellers receive multiple offers, and they typically come back to their long list of potential buyers requesting best and final offer. Best and final offer means you provide the highest you're willing to pay on a home with the hopes that the other person's offer isn't higher than yours. We also have the escalation clause. This allows you to compete with the high offers rather than having to counter back and forth. This isn't allowed everywhere, but for example, if I have an escalation clause that says my offer is $300,000 and it will escalate $1,000 incremental up to a maximum of $4,000, that means if someone comes with an offer of $312, it would trigger my offer automatically to increase to $313. But my maximum of how much I will go is $400,000. So if someone comes with a $401,000 offer, I'm out of the deal. So opening escrow requires two things: you signing the residential purchase agreement as well as submitting a good faith deposit. Your realtor provides an independent escrow company with the fully executed residential purchase agreement. The RPA has the good faith deposit term in the agreement, and good faith deposit is the money that will be wired to the escrow company and is fully refundable depending on the contingency. If you pass the contingency period, that good faith deposit is applied to your down payment or your closing costs after you authorize its release. That means you have to sign to release your good faith deposit. Okay, contingency period. This period represents many opportunities for you to either decrease your offer on the home or leave the deal entirely. Contingencies are put in place to protect you as a buyer. If the property's conditions prove to be not as expected, or the property is too overvalued, or your lender is unable to loan you the money. So there are 3 common contingencies: appraisal, inspection, and lending. So appraisal can happen before or after an inspection. For my first property, my appraisal happened after inspection. So it is the lender's responsibility to get the appraiser. It is not your responsibility, but the costs do come out of your pocket as a buyer. Even if you decide not to go through with the buying process after the appraisal, you will still have to pay the fee. It can cost about as low as $300 to as high as $1,000 depending on the type of property and the size of the property. If the appraisal value is greater than the purchase price, that's a good thing. You are basically getting free money as equity into your property. But if it is less than the purchase price, then you have a problem. Lenders won't lend more than the home value. But there are 4 ways you can handle this situation. 1, you can ask the seller to reduce the price. 2, the seller can reduce the price just a little bit, but you have to cough up the difference. 3, the seller refuses to reduce it, and you have to cough up the full difference. Or 4, you both agree to cancel the deal and you receive your good faith deposit back. So inspections are very crucial. It can cost about $300 to $1,000 depending on the size of the property and the type of inspection that you request. So it's very important that you ask a professional home inspector to take a look at your housing system, appliances, plumbing, fixtures, all the exteriors, termites, pool, structural foundation issues, and even call out the gas company if you can to look at the havoc and heating system as well as your air conditioning. So for my first property, I really wish that I invested in a good professional home inspector. I later learned out that my havoc system and my newly turnkey property requires a $3,000 repair. So if I actually asked the person to take a look at the havoc system or call a gas company, I would have gotten that money back through a discount in the process. So after the inspection, you can ask the seller to do some repairs. The seller can either agree to perform all repairs, agree to fix some of the repairs, or refuse to fix anything, or offer the dollar credit or a price deduction. So after the seller provides his response, you can either accept that seller's response or cancel the deal entirely and get your good faith deposit. So after those 2 contingencies have passed, we start to move into the loan contingency period. So this starts with the title report being issued. So the report shows any and all liens on the property. Liens must be paid off before the seller transfers the property at closing. Your title insurance policies help protect you from receiving a property with liens on. So if you receive a future claim that made before you even own the property, the title insurance company will pay off that lien for you. Then your lender submits your process loan package to the underwriter. So it would include an update on your credit score, your income documents, your bank statements, the appraisal report, as well as the title report. So if your documentation matches the original approval, the underwriter will issue a conditional loan approval. So I know I mentioned good faith deposit, but I did not mention earnest money. They are used interchangeably, but they are different. Earnest money is used to strengthen your offer as a buyer in a seller's market. With earnest money, you get to determine how much money you want to put down as proof that you are serious about this property. But for good faith deposit, it's determined by the lender. But for good faith deposit, it is determined by the lender. But both are applied to the closing costs and are refundable if you have contingencies. So here's an outline of these 3 contingencies. These are very important. I know I keep mentioning this, but this is a very crucial time to decide whether a property is right for you and whether you want to back out. So these 3 contingencies can be removed by your signature, but I really do advise against them. Removing these contingencies could mean you're less protected as a buyer. So I also provided the average length of when these contingencies are contracted. For instance, after the 17th day, you decide that you don't really like their appraisal value. It was way too low, you want to back off, it's too late. These days do vary based on your contract with the seller. They could be 10 days to 20 days. It's all up to the agreement between you and the seller. So after getting the conditional loan approval, we have the second half of the contingency period, which involves getting the homeowner's insurance, as well as the environmental hazard report, seller's disclosure, any HOA documents if you're buying a condo or a townhome, and as well as the contingency release form is being signed. So now we have the environmental hazard report that is provided by Escrow. This report will only satisfy the statutory obligations of the seller and his or her agent. So since 1998, the law in California requires that specific disclosures relative to the sale of residential properties. So the report includes all of the following natural hazard disclosures, from flood to fire to earthquakes, all of the potential environmental dangers that you might face by owning the property. Then after receiving the environmental hazard report, you have to receive the seller's disclosure. States like California, New York requires residential property sellers to disclose in writing details about the property they have on the market. So HOA documents are provided by Escrow indirectly from the seller. So Civil Code Section 4525 lists the disclosures required of HOA. They must provide information on the finances, the fees, the fines that you will get, the rental restrictions, even down to the meeting minutes. So this is very important if you're interested in buying a condo or a townhouse. This really lets you know whether you can run a genuine business out of these properties. I encourage people to ask for HOA documents during the contingency period, specifically before inspection. You want to be able to determine whether this property is worth investing into. So now we're getting closer to the end of this tunnel, especially when you start signing important documents like the contingency release form. And this is signed only after the loan is approved. The appraisal is accepted by the lender and the conditions of the property or repairs that are agreed upon is completed. The buyer would then sign all contingency release forms. At this point, as a buyer, your good faith deposit and your earnest money becomes non-refundable and you're agreed to close the transaction. So we are getting closer to being like this family, all happy and moving in, but there are still two parts to this process left. The closing period involves signing more documents, getting your loan documents prepared, getting a home warranty, doing final walkthrough, setting up your utilities, wiring money, all of the work. But trust me, it's gonna go so fast, it's gonna feel like it's only taken 2 days. So after signing your contingency release form, your lender will issue the closing disclosure form for you to sign, which confirms the loan's terms, interest rates, the fees. This is really the test of your lender's ethics. Because if your lender provides you a different loan term, interest rate, and fees from the beginning, then his or her business is really questionable. So this must be signed no sooner than 3 days before the final loan documents are signed. So after that disclosure is signed, the lender prepares a final loan documents and release them to Escrow for the buyer to sign. These documents cannot be signed until at least 3 days after you sign the closing disclosure. So home warranty is the responsibility of the escrow company and the seller. If it's agreed upon in the contract, the seller will order a home warranty for the buyer. So a home warranty is an annual service contract that covers the repairs or replacement of important appliances and system components that break down over time. I told you all that I found out that my Havoc system was crap after I purchased my property, but luckily the seller had a home warranty in place for me. So the Havoc repair was reduced from $5,000 to $3,000. Just so you guys know, home warranties are great for things like a repair on your refrigerator or your stove, but they're not ideal for a lot of other situations like my Havoc system. I still have to pay $3,000. So signing a loan, this is when things get real. So signing the loan, so this is when things get real. You guys probably have seen pictures of people signing paperwork, taking pictures with the big banner or their keys. Escrow will arrange for a notary to call the buyer and schedule a loan signing with the buyer at home or in the escrow company office. Just know that if you decide to do it at home, it's an extra fee for you. I advise people to do it in escrow if you want to save some money. So final walkthrough. This is not a home inspection. This is not even a chance to negotiate with the seller, and it's definitely not contingent on the sale. It's an inspection performed an hour or a few days before the transaction is settled, and the purpose of it is to make certain that the property is in condition that you agreed upon with the seller. So if the seller agreed to repair the Havoc system, for instance, yes, I'm still annoyed by that, and I come in and it's still the same Havoc system, then we have a problem because he is violating the contract. So changing utilities. This is the responsibility of the buyer. I advise people to contact the utility services 3 to 4 days before move-in. Aim to have utilities running at least 1 day before you move in. You don't want to find out that you don't have gas in your stove and you're about to cook a meal for your family, but there's no gas on. You don't want your tenants to also experience that as well. So please contact your gas company, electric, water if you need to, phone, and cable. Finally, we are moving money, y'all. So this is a very important step, wiring money to escrow. There's a huge wire fraud that's happening these days. So this is very important that you have the correct numbers, the account number, routing number, as well as the amount that's required in the closing disclosure documents. That's your responsibility as a buyer. Because if you wire it to the wrong account, you will not get that money back. So the lender will wire the loan proceeds to escrow as well. Okay, after you have wired your money, yes, now we move into the deed recording. And this is the responsibility of escrow. The escrow company releases the deed to the county courthouse, and the sale is recorded in public records. Yes, you officially have your name on the property. So the realtor releases the keys to the house to you as the buyer. So after you receive the keys, please change your locks. It is a sensible thing to do because that previous homeowner could have copies to the keys and can easily break into your home. That might just be the New Yorker in me, but I say change the locks. After you change the locks, then you should move in. So before you start planning for that first homewarming party, let's discuss the first mortgage payment. So during closing, interest is collected from up to over 30 days before the first full month. This is collected via closing costs. As you may know, that mortgage payments include both interest and principal. But interest is always paid over 30 days in array, while principal is paid going forward. So for example, let's say you close on March 15th. You will be charged a prorated daily interest to March 31st, which is the last day of the month, on your closing statement and collected as a closing cost. This interest at closing will cover the interest due on your mortgage for the last 16 days in March. Then your first mortgage payment will be due on May 1st, and that payment will include interest for April. Now you can start the party, but be sure to invite me. I love a good party. So thank you all for watching this very long video. I hope that it was valuable. I hope it makes your buying process easier. And I do want to discuss some upcoming videos that I hope to do. Next up, property valuation. This is where I go into the nitty-gritties of evaluating a property and how you can easily do it on your own. Bye. Thank you.